Hello, mic test. Yeah, hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. Kelvin here again. Happy Friday, and I hope that you guys have a great day, so far. So very interestingly, today's will be a very interesting day again over here. So before we kickstart our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, just give me a couple of seconds to make sure everything is good. All right, so I think the sound check and the visuality is fine right now. So as usual, before we jump straight into the gist of our daily dose, which is the intraday technical outlook on all those broad-based cross-asset classes, ranging from the 4 major US dollar pair, the 6 major stock indices globally, and the 2 key commodities market, which is i.e. Gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape yesterday, as well as in early today's Asia session in terms of news flow, relevant economic data release, and their impact on the broad-based cross-asset classes on the intraday basis. All right, so let's have a recap what has taken shape yesterday first before the start of the US session. So before the start of the US session over here, we do have this key economic data release, which is the core PCE price index, which is the what I call it preference inflation gauge that is being monitored by US Federal Reserve officials to gauge the inflation trend in the US economy. And from there, they will actually based on this key inflation gauge metrics to set their monetary policy stances. So yesterday, core PCE price index came in rather stubborn on the elevated side of the story. Market participants expecting it to dip slightly by 1 basis point to 2.7% year on year for the month of June, but instead it came in higher at 2.8% at the same rate that was being printed in the previous month of May. So if you look at the trend on the core PCE price index on a year-on-year basis over here, we see it rather stubbornly elevated. So if you look at the 5-year trend, right, so it's just hovering stubbornly at the 2.8% level, 2.9% level since December 2024, and it's not inching downwards. So it's just the rate of growth is rather constant at around the 2.9% to 2.8%. Still recall that the Fed desired target is to inch down towards the 2% level. So that being said over here, it seems to us that things are inflation trend in US is still not inching downwards as the Fed desired, rather sticky on the elevated side at 2.9%, 2.8% year on year. So that causes the dovish expectation that is being placed on the Fed prior to the FOMC meeting yesterday, where market participants is expecting the first rate cut by the Fed in 2025 to come in next month in September. Now it's August already, next month September, and that probability has started to reduce again yesterday. So what do I mean by this? By looking at the CME Fed Watch 2 over here, let me expand my screen so that you guys have a better view. Okay, so this is the next meeting, 17th of September, where the Fed Funds futures traders assign a probability whether the Fed will cut or hold on the 17th of September meeting. So the current rate is at 4.25% to 4.5%. So previously, there was a high odds about 60 over percent. Okay, so what we could see over here, at 4% to 4.25%, prior to the FOMC week, this week, that means a week ago on the 24th of July, market is assigning about 58%, 60% chance, and a month ago it was 75%. So previously there was a high chance that market participants in the Fed Funds futures contract market expecting the Fed to do the first rate cut on the 17th of September, but now that odds has been dramatically reduced to 41%. So previously, before the release of the core PCE data yesterday, it was at 47%. So that was also greatly reduced after Fed Chair Powell not so dovish press conference. And this odds has been reduced much lower yesterday after that rather elevated core PCE number for the month of June to 41%. So market now is not thinking of the Fed cutting rates in September. And if you look at the aggregator tab over here, so the aggregator tab market now is looking to push down the calendar, or push down the can, to have the first rate cut to come in October, the 29th of October 2025 FOMC meeting, to bring it down to 4% to 4.25%. That's a high chance of 76%. And right now, market after that do not expect the Fed to cut in December anymore. So it's rather a low chance right now of only 30% chance of the Fed will do a second cut before 2025 ends, which is on the 10th of December FOMC meeting. So the initial two interest rate cuts prior FOMC meeting, prior the course PCE data released yesterday, has been evaporated, and right now market participants only assigning one interest rate cut in the 2025 before by the US Federal Reserve. So that's actually way below the projected two interest rate cut in the last dot plot among the Federal Reserve officials. So with that, that causes the dollar to remain rather firm yesterday against the major currency. So the dollar continues to rally higher, and also based on our expectation, initially we expected the yen to actually strengthen slightly, but it didn't happen. So that was actually dosed off by Bank of Japan Governor Uda press conference at the 2 p.m. mark, 2 p.m. to 3 p.m. mark Singapore time yesterday. So what Bank of Japan governor did, he actually dosed off the expectation of the next interest rate hike in by BOJ. So he actually tempers that near-term rate hike expectation by actually issuing a rather dovish press conference, despite the fact that the quarterly outlook report do upward revision in the inflation trend in Japan for fiscal year 2025 this year, and fiscal year 2026 as well. So what do I mean by this over here is that let me do a quick recap. Right, so at the bottom, so this was the projection. All right, so BOJ actually sees stronger inflation trend going forward. Actually they revised the expectation upwards over here. So for FI 2005 they revised it up to 2.5%, and for FI 2026 they revised upwards to 1.8% over here. So that initially causes the dollar yen to inch down. That means the yen strength to come back in the early Asia session yesterday. But right after, at the 3 p.m. mark Singapore time, the Japanese yen strength evaporated and causes the dollar yen to spike up above 150 level per barrel and hit a 4-month high, and so break above the pivotal resistance at 149.60 that we have on the dollar yen, which is so above the 200-day moving average. So what causes that? Because of the rather dovish remarks by Bank of Japan Governor Uda over here. So he mentioned over here is that right now I don't see us being behind the curve. That means, i.e. they are in no rush of hiking rates, despite the fact that inflation trend is being upgraded by the latest quarterly outlook from BOJ yesterday. Then neither do I think there's a high risk that we will fall behind. All right, Uda said in his post-decision press conference. And we do not see the fog suddenly lifting over trade, despite progress being made through the US-Japan trade deal over here. Because of this, it causes the dollar yen to spike up. So what do I mean by that? So if you look at the trend over here, so this is what I mean. So you know that this is a 5-day rolling performance of the US dollar against the major currency as of we are speaking right now. So what I could see at this point in time, look at my cursor at here. Okay, initially at the start of yesterday's Asia session, the dollar yen plummeted and hit the intraday low at 2:25 p.m. Singapore time before spiking upwards over here. So this spike up in the dollar yen is pretty much caused by this BOJ governor press conference dovish remark, and that also allowed stop loss level to be triggered because of the 491, pardon me, that this particular trend on the dollar yen over here. So what do I if I were to share with you guys on the dollar yen, yeah. So this is the dollar yen. So this is what I mean. So upon the break of this 14960 level and the 200-day moving average, so we see a very sharp push up over here. So this is potentially also stop loss level being triggered as well, right after the breakage of that 14960. So now with that, let us now also continue with the FX market over here. So the FX market, the dollar trend continues to be rather resilient at this point in time. So primary movement about the dollar strength also causes by latest US tariff remarks by Trump himself. So we know that now is the 1st of August deadline. There's actually several countries that are still in negotiation. So yesterday, Trump actually shoot out a rather hawkish tariff rates on Canada and as well as Switzerland, especially Switzerland where market participants expecting the rate to be lower. So what is the rate over here? So let me share with you guys. All right, so Trump hits out at Canada and Switzerland hard as he announces global tariffs. So one thing positive, he decided to keep the minimum global tariff rates as a base rate of 10%. Previously he threatened it to be higher at 15%. All right, so what's surprising is for Switzerland and Canada, he actually have a very high tariff rates on Switzerland at 39% and Canada at 35% over here. So because of this 39% on Switzerland rate, that causes the Swiss to actually weaken against the dollar pretty dramatically. And what we could see over here is that the dollar Swiss rate itself also broke above a key resistance level. Right, so this is the dollar Swiss. So if you look at the dollar Swiss, yesterday's bullish breakout, we could see over here, it broke out above this medium-term descending channel that is previously in place from 3rd of February 2025 high, this broad base. So what it means that yesterday's price action and also that rather high a tariff rate that is being imposed by the US White House administration of 39% causes the Swiss franc to weaken dramatically against the US dollar. And also based on the technical analysis perspective, the dollar Swiss we call it a medium-term downtrend phase has more or less ended by yesterday's price movement, reinforced by that higher tariff rate imposed by US White House. Potentially, we may also start to see further dollar strength playing into the FX market picture as well, given that the dollar Swiss has started to broke out this medium-term descending channel that is previously in place since 3rd of February 2025 high, damaging this medium-term downtrend of this dollar Swiss and kickstarting a potential multi-week dollar strength corrective rebound into the Swiss. And that could have a spillover impact into the rest of the FX market, potentially reinforcing this ongoing corrective rebound that is being seen in the US dollar. So what do I mean by this? If you look at the dollar index, so the dollar index continues to shape a rebound for 6 consecutive sessions, starting from 24th of July, 1, 2, 3, 4, 5, 6 over here. And this potential, we call it rebound, could continues to extend further after if breaking above 140 resistance level. It potentially could seek out 102 figure level followed by 103.50, which is the 200-day moving average. And if you look at from a monthly perspective, the monthly candle, since we know that yesterday is the last trading session for the month of July, so it ended July with a positive note, up positive 3.4%. So this dollar index managed to get a first positive monthly return since the start of this year over here. So since the start of the year, it has been consecutively down for 6 consecutive months, and this is the first month that it managed to get a positive return in the month of July. So that also potentially reinforce a ongoing multi-week corrective rebound sequence to retrace that prior 6 months of US dollar index decline over here. All right, so net overall, right now we are actually seeing the potential onset of a extensive US dollar strength corrective rebound coming into the FX market that may continue to last for several weeks, all right, in the month of August. right? So now this is for the story on the FX market. So how does the performance of the global stock market was yesterday? So let me start with the US market. So the US market, initially there was actually a gap up of 1%. All right, so for the S&P 500 and the Nasdaq 100 as well. All right, so there was a gap up at the first hour of the US stock market, but however this gap up is unable to maintain this intraday bullish momentum and starts to actually temper off at the 10 p.m. mark Singapore time yesterday. So what causes the initial gap up was the rather rosy price performance on Microsoft and as well as Metal, especially Microsoft yesterday hit a 4 trillion market value mark over here. All right. So, but however, price action continues to dwindle downwards due to profit taking, and as well as that ongoing 1st of August tariff deadline coming into the picture as well. So in today's Asia session, what we could see over here is that the Nasdaq 100 futures and the E-mini S&P 500 futures. So the S&P 500 E-mini futures are almost unchanged and not that bad, negative 0.06%. The Nasdaq E-mini futures is down slightly, negative 0.13%. So what causes this rather lackluster movement, not a dramatic sell-off, is also due to two key earnings release of the two mega cap technology stock, which is Apple and Amazon, that managed to actually that has taken shape after the close of yesterday's US session, which is Singapore time 4 a.m. after 4 a.m. today. So let's take a look at the share price of Apple. So Apple managed to actually close in the green after US session closes, means after US session hours. So it was down 0.71% in the normal US trading session yesterday. So right after 4 a.m. Singapore time today, Apple released its Q2 results, and the post price action was rather positive, up 2.42%. So what Apple did is that Apple managed to beat expectation. All right, Apple growth actually rebounded over here, and also of the iPhone iPhone 16 line, and their revenue in China, which is a key market, also improved as well. So Apple Inc. reported its fastest quarterly revenue growth in more than 3 years, easily topping Wall Street estimates after demand pickup for iPhone and other related products in China. So that managed to actually causes Apple expose earnings release share price after the close of the US session, which is after 4 a.m. Singapore time today, to go up, and that actually muted the negative impact of the tariff news that could have on the E-mini futures contract on the S&P and the Nasdaq 100. But however, Apple news is being kind of slightly overshadowed. Apple positive after hours US trading session share price performance has been kind of negated by the bearish after hours share price movement of another mega cap stocks, which is Amazon. So Amazon initially it was very positive yesterday. Before the close of the US session, it was up 1.7%, and upon after the release of its Q2 earnings result, after the close of the normal US session, that means after 4 a.m. Singapore time today, it actually plummeted down by negative 6.6%. So due to rather weak guardians, especially also on one of Amazon key product segment that is related to the AI data center, which is Amazon Cloud, has been underperforming Microsoft and as well as Alphabet cloud division. So what do I mean by this? So if you look at Apple, all right, Apple actually falls based on so-called profit after profit guidance on the weaker cloud growth segment, all right, that spoke traders and investors on Apple share price. So what do I mean by this? Yeah, this is the Apple cloud growth. So Apple cloud results, or the segment, actually grew only we call it Amazon web services, not Apple, it's Amazon. I've got tongue to stick, my apologies. So Amazon web services, which is its cloud business segment, which is pertaining to the AI team play, actually lagged behind its competitor, which is Microsoft cloud segment, Microsoft Azure and Google Cloud. So Amazon Web Services only grew 17.5%, way below the 30% that is being recorded by its rivals, Microsoft and Google. So that actually causes Amazon exposed earnings share price to plummet by -6% after 4 a.m. Singapore time. So that actually kind of offset the rosy price performance of Apple, which is up by 2.4%. So the net result is what we could see is a rather lackluster movement of the S&P 500 E-mini futures and the Nasdaq 100 E-mini futures, but not a significant sell-off over here. And what's interesting over here is that despite that tariffs, the latest tariff news flow out from US, it didn't has a dramatic across the performance of the Asia Pacific stock indices. Means there is no major sell-off in the Asia Pacific stock indices. In fact, the Nikkei 225 tried to actually recover slightly, which is only down by -0.8%. Later I'll share with you, if you look at the futures market, it's actually up 0.6% after yesterday's sell-off yesterday. And even the Hang Seng Index is almost unchanged right now. The Hang Seng Index is actually down only marginally -0.05%, but whereas the higher beta H, the Hang Seng Tech Index that comprises of the China big tech stock is up marginally 0.08%, and the HSCEI, the Hang Seng, we call it those H shares, means the China shares, key China shares that is listed in the Hong Kong Stock Exchange, that is being, we call it composed by this benchmark H shares. HSCEI, the Hang Seng China Enterprise Index, is only up 0.13%. And over to other Southeast Asia benchmark stock indices, we also have the STI that managed to close up higher right now at 0.13%. However, other markets is actually down. The Australia ASX 200 is down by -0.7%, down by -0.7%, and the Thai X and the Kospi 200 is down by -3% and -0.5%. So it's a rather mixed bag of performance, not a across the board sell off in the Asia benchmark stock indices, which is pretty much of a positive story, I would say, rather, despite this higher tariffs that is being inflicted on Canada and Switzerland. All right, at this juncture. So, and also despite the fact that the dollar strength is firming as well, it didn't actually inflict a much negative feedback loop into the Asia Pacific stock index, which is rather a mixed bag performance, I would say. So rather a consolidation story to actually talk about over here. So that actually sum up the first segment of today's daily dose. So let us now move on to the second segment, which is the intraday technical outlook on those broad-based cross asset classes, starting with the FX market first. So with that, let me expand my screen so that you guys could have a better view of the chart itself. All right, so let me start with the FX market over here, which is the euro dollar. All right, so the euro dollar, yesterday we do have a bearish bias over here, so it actually hit our first support at 114 figure level. After hitting 114 figure level, it just traded sideways throughout the US session over here. And interestingly, while it actually hit the first support level, the RSI has starts to shape a bullish divergence as well. And in today's Asia session, it continues to slope upwards. So what it means that over here in terms of momentum analysis, based on a very short-term intraday movement itself, it starts to actually showing signs of downside momentum easing at the 114 figure level over here. So given that the fact that today there will be another important event that could impact the euro dollar, which is the non-farm payroll data, that's the key labor market data of the US economy. So later I'll share with you some details on that when I cover the third segment of the daily dose. So with that, slowdown in this downside momentum, as indicated by this positive observation in the hourly RSI, which I explained earlier on the euro dollar, I've now lower conviction to maintain my bearish bias. Instead, So instead, there could be a chance of a minor corrective rebound taking shape on the intraday basis for the euro dollar as we speak right now. So I'll be using 113.70, 113.60 as my short-term pivotal support for today, to have a bullish bias for a minor counter trend rebound scenario to take shape on the euro dollar, to retrace that steep sell off that has taken shape from the start of this week, which is Monday, all the way down to yesterday's early European session over here. So there could be a potential minor corrective rebound to retrace this steep 4 days of sell off in the euro dollar. So first resistance level to watch will be 114.60. So this will be something like an upside trigger level. A breakout above 114.60 potentially take us up towards 115.20, maximum 115.70, which is the 50-day moving average, acting as the next intermediate resistance level as well. And if we do the Fibo retracement of that 4-day of steep sell off, the level of 115.70 confluence very closely to the 38.2% Fibo retracement level over here. However, if price action continues to break down below 113.60, the bullish bias for that minor corrective rebound scenario will be invalidated and continues to see the downside impulsive movement on the euro dollar to take hold again, to expose the next intermediate support level at 113.10, 113 figure level, which is the psychological level, and the minor swing low of 30th of May, and also close to the one-time Fibo extension on this ongoing downtrend phase, from the minor downtrend phase from the high of 24th of July. So that's for the euro dollar. Next up will be the sterling dollar over here. So the sterling dollar also continues to actually shape downwards over here, inching below our pivotal support level, pivotal resistance that we have at around the 132.40 figure level, fast approaching our first support at 131.70, 131.40. And very interestingly, the RSI didn't shape a bullish divergence that was being depicted on the euro dollar. So price action going to shape lower low in line with the price action on the raw price action of the sterling dollar. But given that the euro dollar is showing signs of downside momentum easing, I don't want to be so aggressive, be bearish on the sterling dollar, given that there has some form of direct correlation, especially with the ongoing release of a key economic data that could impact the sterling dollar as well, which is US non-farm payroll data. So with that, I will have a cautious stance. Instead, I'll flip to a neutrality stance for today on the sterling dollar. So neutral between 132.40 and 131.70/131.40. So if we start to see a bullish breakout above 132.40, then the sterling dollar will potentially also shape that minor corrective rebound sequence to retrace this 4-day of steep sell-off that's taking shape on in fact, they actually sold off earlier on last Thursday instead on the sterling dollar. So next resistance level to watch will be 133.15 next on the intraday basis. So that's for the sterling dollar, flipping to a neutrality stance for today. Next up will be the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar, yesterday we do have we wanted to play that counter trend rebound scenario because it starts to stall at the 64.30 level. During the Asia session, it managed to actually rally further, but after the start of the European session at 3 p.m., the rally actually dwindled off or ease off at the first resistance at 64.70 before have that intraday sell off throughout the European session and heading throughout the US session, but managed to stall in today's Asia session over here. So what we could see over here is that the Aussie dollar now managed to shape a very clear bullish divergence. All right, similar low on the price action on the raw Aussie dollar chart, but the derivative of the hourly RSI starts to print out a bullish divergence, indicating that yesterday's European to US session intraday sell off, the downside momentum has started to ease. So with that, I will have a neutrality stance for today. Potentially it could be a sideways movement on the Aussie dollar. So neutral between 64.70 and 64.30 for now, for today on the Aussie dollar. Unless we're able to have a breakout above 64.70, then potentially that minor corrective rebound a sequence may extend further towards the next resistance at 65 figure level, and so very close to a 50-day moving average. So that's for the Aussie dollar. Now, next up will be the dollar yen. Given the bullish breakout of that 14960 level and the 200-day moving average, we got to respect that bullish momentum breakout. So the dollar yen, what you could see is now is actually doing a pullback, given that it starts to actually exit from the overbought level that is being printed out in the US session yesterday. But while it exit from the overbought level, prior to reaching overbought, it didn't actually flash out a bearish divergence. There's no bearish divergence. So price action on the RSI move in line with the price action, the raw price action of the dollar yen. So given the fact that it has just exited off from the overbought level, there could be a minor pullback heading into the European session. So first support level to watch will be 15015 level, followed by the 14960. Previously medium-term pivotal resistance now turns into a pivotal support level to watch out for today, which is so confluence with the 200-day moving average. So using 14960 level in this potential ongoing minor pullback, we will flip to a intraday bullish buyer stance on the dollar yen. First resistance level to watch will be 15115, followed by 15130 is a range. Above it potentially sees 15235, followed by 15260 level, which is a Fibo extension cluster level, and 15235/60. If you go back accordingly over here is the minor congestion area of 14th of February and 19th of February this year, right? And only bearish reversal and a hourly close below 14960 will invalidate yesterday's bullish breakout and start to see another round of choppy price movement downwards towards 14875 in first step, where this was the initial sell-off after the release of BOJ quarterly outlook report that show a upgraded forecast on inflationary trend, but price action can't break down further at 14875. Only a breakdown below 14875 will allow the bears to gain more traction to revisit 14790, which is the minor swing low of 30th of July, and so correspond to this rising 20-day moving average as well. So that's for the dollar yen. Flipping to a bullish bias, but in the first step there could be a minor pullback with key pivotal support to watch for today will be at 14960. All right, so now let us move our attention now to the major stock indices, starting with the Hong Kong 33 over here. So the Hong Kong 33 managed to slide down as expected and almost hit our 20-day moving average, and as well as this minor descending trend line that I drew from the low of 19th of June over here, which is at confluencing at 24,650 level. So using this 24,650 level as my short-term pivotal support level. And also what's interesting over here is that as price action continues to slide down from the start of yesterday's Asia session all the way down to the US session, the RSI has started to slope upwards. All right, so indicating that the downside, this is a bullish divergence at the oversold level, indicating that yesterday's bearish momentum of the sell-off that has taken shape from yesterday's Asia session all the way down to the US session, the downside momentum has started to ease off. So with this easing off of the downside momentum, I do not want to be so bearish to continue to have my bearish bias that we have yesterday. So instead, I will flip to a potential bullish bias for at least a minor recovery to take shape in today's Asia session. So using in today's session, not Asia session, because the Hong Kong 33 will continue to trade into the early part of the US session for today as well. So using 24,650 as my short-term pivotal support level for today on the Hong Kong 33, that is representing the Hang Seng Index, we will flip to a bullish bias stance for at least a minor recovery for today's intraday session. Resistance level to watch will be a zone over here. We'll be taking into account of yesterday's Asia session high, which is at 24,960/25,105, right? So it will be like a zone over here, 24,960. All right, so 24,960 slash 25,105. Only a bullish breakout above 25,105 will potentially starts to see the start of a renewed impulsive up move sequence to revisit 25,520 next. However, if price action starts to break down below 24,650, then today's intraday bullish bias for that minor recovery scenario will be invalidated to see the continuation of this minor corrective decline sequence extending downwards further towards 24,400, maximum 24,150, which confluence with the 50-day moving average. So that's for the Hong Kong 33. Next up will be the Nikkei 225, representing the Japan 225. So the Nikkei 225 and the or the Japan 225 continues to be supported by the intraday low that was being made on this Wednesday, all right, price action. So still recall that we also state that at this point in time there could be an inflection level given that price action of that retracement that's being seen from the prior two steep day rally of 22nd of July to 24th of July has made its target, which is the 61.8% FIBO retracement, right? So given that the dollar yen is also the strength of the dollar yen, which is the Japanese weakness, is also supporting the export side of the Japanese economy. That also provided a bit of positive cushion on the Japan 225. So with that, I will have a slightly adjusted pivotal support level for today, which is 40,460, because given that price action also tried to test it in today's Asia session, but managed to see a positive price reaction of it. So I will have a slightly upwards adjusted pivotal support for today at 40,470. Maintain my bullish bias for the Japan 225. First resistance level to watch will be yesterday's European session high at 41,285. A breakout above 41,285, potentially revisit 41,650 in the first step. Only a bearish breakdown below 40,470 will negate today's bullish tone to see a further slide to revisit the next key short-term support level at 40,130, which is the rising 20-day moving average, and very close to this so-called former medium to minor range resistance from the high of 4th of July to 22nd of July now turns into a pullback support, and also confluence to this medium term ascending trend line that I drew from the low of 23rd of May. Over here, only a bearish breakdown below 40,130 that will trigger off a steeper corrective decline sequence, a minor corrective decline sequence extending further towards the downside to expose the next intermediate support level to watch will be the minor swing low of 22nd of July at 39,455. All right, so that's for the Japan 225, maintaining our bullish bias with a slightly upward adjusted pivotal support for today at 40,470. Next up will be the Germany 30, representing the German DAX. So the Germany 30 initially it actually tried to actually pierce up higher, but it can't maintain the bullish momentum to revisit the range resistance level at 23,140 before plummet downwards towards the start of the US session, but managed to find support right exactly at our pivotal support at 23,930 again, and forming this bullish hammer candlestick at the start of today's Asia session, which is also the 50-day moving average as well. So like I mentioned earlier, the German 30 continues to trade within this minor sideways rangy configuration since the current fresh all-time high that was printed in 10th of July over here. So given the fact that it managed to stage a bullish reversal candlestick and holding above the 50-day moving average, and as well as holding above our pivotal support level, we will still continue to maintain our bullish bias, but however it will be churned within this sideways range configuration unless it has a bullish breakout above 23,140. So for today, pivotal support at 23,930, potentially it could actually revisit the middle part of the range again. So on a lower time frame, okay, this will be the first support level to watch, which is the minor swing high of the US session high, which is 24,120. So that's the US session high yesterday on the Germany 30, 24,120. Above it, potentially revisit the 220-day moving average, I think as the next intermediate support, I think as the next intermediate resistance, pardon me, about tongue twisting at the 24,210 level. Only a bearish breakdown and hourly close below 23,930 that will invalidate the bullish bias and see a bearish breakdown of this sideways range configuration to expose the next intermediate support level, and that means i.e. we may start to see a much more pronounced corrective decline sequence going forward. But in first step, the next support level to watch will be 23,640 for today after the breaking down of 23,930. So that is the minor swing low of 2nd of July, and yeah, 2nd of July over here. All right, so i.e. no change, still hold using 23,930 as my short-term pivotal support level on the Germany 30, looking for a potential bounce back towards the middle part of this sideways range. Next up will be the US major stock indices, starting with the US Wall Street 30 that represent the Dow Jones Industrial Average. So yesterday we flipped to a neutrality stance on the Dow Jones Industrial Average due to mixed element. And what's interesting over here is that after sliding down below the lower neutrality limit, it managed to hit the next support level at 44,010. And upon shaping this lower low in price action, what we could see there's a lower low. The corresponding period during this lower low that's being formed on the US Wall Street 30, the RSI starts to shape a bullish divergence, indicating that yesterday's US session sell-off in the raw price action of the US Wall Street 30, the downside momentum has eased off. So first support level to watch will be at the 44,010 level, given that it hasn't broken above the first resistance at 44,310. Just in case of any whipsaw, I don't want to put 44,010 as my pivotal support level. I will use a slightly lower level. We also confluence with another key element, which is the rising 50-day moving average at 43,800, 43,600 level. So 43,800, 43,600 will be my short-term pivotal support. We will flip back to a bullish bias for today on the US Wall Street 30. First resistance level to watch will be 44,390, followed by 44,780. So that was the rejection level during the release of the FOMC monetary policy statement on Wednesday. All right. However, if price action continues to thunder downwards and break below 43,600, today's intraday bullish bias recovery signal will be invalidated to see the continuation of this ongoing minor corrective decline sequence to stretch it down further towards the downside, exposing 43,170, maximum 42,860, which is the 200-day moving average, and as well as this medium-term ascending trend line from the low of 23rd of May. Right, so that's for the US Wall Street 30, flipping to a bullish bias using 43,800 / 43,600 as my pivotal support zone. Next up with the S&P 500. So the S&P 500 yesterday squeezed up and hit our first resistance zone at 6,000, pardon me about tongue twisting, 6,430, 6,450 level. Intraday high, fresh all-time high at 6,442 before selling off in the entire US session over here. So interestingly, it broke down our Titan short-term pivotal support, but managed to find support level at close to the 20-day moving average at 6,330. So I'll be using a slightly lower pivotal support level for today at 6,290, given that it's now coming very close to the 20-day moving average, and also the RSI has managed to find a similar lower, a slightly higher lower. If I go to the RSI, all right, over here, notice that there's also a bullish divergence that's being formed on the hourly RSI, whereas lower low is being formed on the SPX 500. So given that this bullish divergence that's being formed on the hourly RSI, potentially that downside momentum of yesterday's US session sell-off has eased off. So because price action is still remaining below this intermediate resistance level, which was the rejection level that's being seen on the intraday US session yesterday, the last hour of the US session at 3 a.m. Singapore time, unless we have a bullish breakout above 6,376 during the European session, therefore that I would tighten the pivotal support to 6,330. So since it hasn't broken above 6,376 as we are speaking right now, my pivotal support will be at 6,290, which is the minor swing low area of 18th of July and 22nd of July, and also over here. And if you were to do a Fibo retracement from the last significant rally from 19th of June all the way up to yesterday's fresh all-time intraday high, okay, that was also slightly below the 23% Fibo retracement level. Okay, so using this 6,290 as my short-term pivotal support for today, we will still maintain our intraday bullish bias given the positive element that is being seen on the hourly RSI right now, despite yesterday's intraday sell-off in the later part of the US session. First resistance level to watch 6,376. Above it will potentially revisit 6,430/6,450. Only a bearish breakdown below 6,290 that would invalidate today's intraday bullish bias to see the extension of this minor corrective decline extending downwards towards 6,227, which is also pretty key support level. Is the lower limit of this ongoing medium-term ascending channel that I drew from the low of May, 23rd of May 2025 low. All right, so that's for the SPX. Lastly will be the Nasdaq 100. So the Nasdaq 100 also at the start of the European session, it managed to hit our first resistance level before selling off over here. So this sell-off also managed to store at close to the 20-day moving average. So I'll be using this 20-day moving average here, and so with the confluence of this minor swing low of 23rd of July and 22nd of July, or acting as a similar support level at 23,020. So using 23,020 as my pivotal support for today on the Nasdaq 100, we'll still maintain an intraday bullish bias for a recovery to take shape. First resistance level to watch will be 23,430. Above it sees a retest at 23,710, which is the current all-time high area. However, if price actually continues to plummet downwards and break below 23,020, today's intraday recovery bullish bias will be invalidated to see the continuation of this minor corrective decline sequence extending further towards the downside, exposing 22,830/22,650 next, which is also the minor swing low area of 8th of July and 14th of July. So that's for the Nasdaq 100. Next up will be the commodities market, starting with gold XAU/USD. So gold XAU/USD, yesterday we flipped to a bearish bias given of the bearish breakdown of the 3,300 medium-term pivotal support level on Thursday. Right during the US session, or at the start of the start of the US session, it managed to retest our pivotal resistance that we have yesterday, 3,310 level. So given the bearish reaction at this 3,310 level, this is indeed a short-term pivotal resistance. So we will still continue to maintain that intraday bearish bias on gold XAU/USD, given that at this point in time, the US dollar is not shaping any very clear bearish reversal scenario or condition. So that could add some pressure on the gold XAU/USD. So first support level to watch will be 3264, which is the minor swing low of area of 30th of June. Breakdown below 3264 may potentially expose the exact swing low of 30th of June 2025 at 3245 level. Only a bullish breakout above 3310 that would negate the bearish bias on gold XAU/USD to see at least a short-term recovery towards the rejection level that's being formed on the FOMC press conference at 33,035 over here. All right, okay, not doing that as well. It's formed during Wednesday European session and Asia session time before the FOMC take shape over here. All right, at 33,034. All right, so this is the next resistance level to watch if 3310 is being taken out. So net overall, whatever bounce that we could see is only potentially a corrective rebound phase, unless very clearly we're able to recapture the 20-day and the 50-day moving average above it, then potentially we could start to see a much more substantial recovery in gold XAU/USD. So for now, still maintain that intraday bearish bias using this key pivotal resistance that we have for yesterday, maintaining at the same level at 3310. Next up will be the West Texas crude oil. So the West Texas crude oil, yesterday we flipped to a bearish bias for a potential corrective pullback scenario. So this corrective pullback scenario has already made our first support level, which is 69, almost mid 69.15, 68.50 level. Printed an intraday low during the US session at 69.32, right? Almost mid already. And what we could see right now, there could be the start of a potential bounce taking shape over here, given that the RSI managed to bounce off from a, okay, let me expose over here, okay, a parallel support level. Okay, RSI managed to bounce off from a parallel support level. So I'll be using this 69.15, 68.50 as my short-term pivotal support level. We also the 200-day moving average as well. And we will flip back to a bullish bias for today, given that the downside support level for this minor pullback has really been made in yesterday's US session. All right. So first resistance level to watch will be yesterday's yesterday's Asia session high at 71.20. All right. Above 71.20 may expose the next resistance level at 72.80, followed by 73.60, which is very close to the golden ratio Fibo retracement of 61.8% of that previous sell-off from 23rd of June to 25th of June. However, if price action continues to plummet downwards below 68.50, then I would say that the last 2 days of bullish price action that is taking this week of bullish price action that's taken shape on Monday is more like a failure bullish breakout above the 200-day moving average, where price action to be choppy again on the downside, exposing in first step the next support level at 67.30. A breakdown below it of 67.30 could actually revisit the range bottom of this sideways range scenario or sideways range support from in place since 25th of June 2025 low at 65.30. So for now, flipping to a bullish bias, given that the RSI momentum is managed to bounce off from a parallel support level using 69.15/68.50 as my short-term pivotal support for today. So that sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for? So like I mentioned, today will be NFP day for the US economy. But prior to the release of the NFP data, let's take a look at during the European session, what are the other data that we should be taking note of. So during the start of the during the mid-European session at 5 p.m. Singapore time, we have the aggregated inflation rate for Eurozone. So the core inflation rate for Eurozone, that will be the preliminary figure for the month of July, will be at 2.2%. Market is expecting 2.2%, slightly below the previous June print of 2.3%. So that could influence the euro dollar, the euro crosses, and the Germany 30 index. Then we have the all important non-farm payroll data. So non-farm payroll data, the headline number, I would say it's a very low ball, not really a low ball number, but slightly below 147K jobs added in July. So if you look at the trend of the non-farm payroll data in the last few months, price action has been hovering around the 150, 120 level. So let me share you guys. Yeah. So since the month of March, it was 120, right? Around 120, then 147, 144, 147. So it's been hovering around 120 and the 150 range. So this time around, the market is expecting a slightly low ball figure of 110. All right, over here. So that is also above the what I call that January low of 111 and February low of 102. All right, so it's still within that rather, holding above that 100 K level. All right, so I would say that it's a rather low ball number again, like the previous concession that was made in 110 previously in the month of for the month of July forecast over here. So for this for the month of June forecast, so for July forecast, our concession 110, it could also be easily be met as well. So it market continues to if the data continues to beat consensus at 110 above 110K figure, that there shouldn't be any major movement on the FX market and even the stock indices as well, unless we could have a very red hot print above 110. That means going above 147 previously at 150 to 160, then that could potentially see a tremendous bounce in the US dollar. All right. And what other key metrics data to watch out for will be the unemployment rate. So unemployment rate continues to be at the 4.1% level, but what's interesting is that the consensus saw a slight increase to 4.2%. All right, so if we start to see the unemployment figure going up at 4.3%, more than what the consensus is expecting, then that dollar strength rebound that is seen at the start of this week could potentially temper off, given that the unemployment rate starts to inch up higher than expected. All right, so that will be the non-farm payroll data. So going forward later at 10 p.m., we have the ISM manufacturing PMI. So that could actually influence the market as well, something to take note of. So for the ISM manufacturing PMI, market is only expecting a slight improvement to 49.5 from a contractionary level of 49 print that was printed in the month of June. All right, and thereafter there will be a rather quiet US session, no Federal Reserve officials speaking thereafter. So with that, that sum up today's daily dose of market insights. I wish you all a happy weekend and a restful weekend, and we shall speak again on Monday. Thank you.